Here's something that will make you rethink everything you believe about wealth in America. Back in ancient Rome, around the year 115, Emperor Trajan decided to solve a population crisis in the Italian countryside. Farmers were abandoning their land because they couldn't compete with massive slave-operated estates owned by the ultra-wealthy. So Trajan created what historians call the alimenta program. He would loan money to landowners at roughly 5% interest, and the interest payments would fund food programs for poor children. Sounds generous, right? But here's what actually happened. The program created a massive concentration of wealth among those who already had land valuable enough to qualify for the loans. Small farmers who needed help the most couldn't get loans because their land wasn't worth enough as collateral. The rich landowners took the cheap money, expanded their operations, bought out struggling neighbors, and within 2 generations, land ownership in Italy became even more concentrated among the wealthy elite. The program designed to help everyone ended up creating a bigger wealth gap. And if you think that sounds familiar, just wait until you see what's happening right now in America with the $1 million milestone. My name is David, and I spend way too much time thinking about wealth inequality and the psychology of how people actually accumulate serious money. If you're someone who feels like the traditional financial advice isn't adding up, like the math you're being told doesn't match the reality you're seeing, or you're tired of being fed the same recycled talking points about saving and investing that your parents heard, subscribe and like this video. It will help more than you think. By the end of this video, you'll understand the exact wealth concentration mechanism that financial institutions benefit from you not recognizing, and why the number of millionaires in America is simultaneously higher than you think and more meaningless than you've been told. Let me take you back to that Roman system for a moment, because the parallels are disturbing. Trajan's alimenta program ran for about 150 years. During that time, historians estimate that participating landowners saw their wealth grow at roughly 3 times the rate of non-participants. The children who received the food aid, most of them grew up to become laborers on the very estates that the program helped expand. The system wasn't designed to be predatory. Trajan genuinely wanted to help, but the structure itself favored those who already had assets. The interest rates were low enough that wealthy landowners could borrow and expand. The collateral requirements were strict enough that small farmers were excluded. And because the loans were denominated in a stable currency backed by the empire, there was virtually no risk for the lenders. Over time, this created a 2-tier system. A small group of families controlled most of the productive land, while everyone else either worked for them or struggled on marginal plots. Now, you're probably thinking, okay, David, interesting history lesson, but what does a Roman welfare program have to do with millionaires in modern America? Everything. Because the same structural mechanism that concentrated wealth in ancient Rome is operating right now in the United States, except it's turbocharged by financial systems that most people don't understand. Let's talk about the actual numbers first. Then we'll get into why those numbers are hiding a much bigger and weirder story. According to the Federal Reserve Survey of Consumer Finances from 2022, there are approximately 24.5 million households in the United States with a net worth of at least $1 million. That's roughly 18.6% of all American households. If you're watching this and thinking, wait, that seems really high, you're right to be surprised. Back in 1995, only about 3.3% of American households had a net worth over $1 million. So in less than 30 years, the percentage of millionaire households went from about 1 in 30 to almost 1 in 5. On the surface, that sounds like amazing news. The American dream is working, right? Wealth is spreading, more people are making it. But here's where it gets really interesting. That $1 million threshold hasn't changed. We're still using the same number we used in the 90s. But inflation has absolutely destroyed the purchasing power of $1 million. $1 million in 1995 had the equivalent purchasing power of about $1.9 million in 2023. So when we say there are more millionaires now, we're comparing apples to oranges. A household with $1 million in net worth today has roughly half the economic power that a millionaire household had in 1995. But we're still treating the milestone like it means the same thing. This is the first layer of the illusion. Now you might think, okay, so $1 million isn't what it used to be, but it's still a lot of money. Most people don't have anywhere near that much. And you'd be right. The median household net worth in America is about $192,000. So even a devalued $1 million is still more than 5 times the median. But here's the thing that nobody talks about. When you break down how people are getting to that $1 million mark, the story gets much stranger. And this is where the Roman connection comes back. Let's look at where this wealth is actually sitting. According to that same Federal Reserve data, for households with a net worth between $1 million and $2.5 million, the average allocation looks like this. About 32% is in primary residence equity. Another 21% is in retirement accounts like 401ks and IRAs. About 14% is in business equity. 13% is in other real estate. And the remaining 20% is scattered across financial assets, vehicles, and other holdings. So for a typical household that just crossed the $1 million threshold, roughly $320,000 of their net worth is their home equity. Another $210,000 is locked in retirement accounts they can't touch without penalties until they're 59 and a half. Let me paint you a picture of what this actually looks like. Meet John. He's 47 years old, lives in a suburban area outside a major city. He bought his house in 2008 for $350,000. He's been paying the mortgage for 16 years. The house is now worth $650,000, and he owes $210,000 on the mortgage. That's $440,000 in home equity. John has been contributing to his 401k for 23 years, and with his employer match and market growth, he's got about $370,000 in there. He's got about $60,000 in a savings account, $40,000 in a taxable brokerage account, and his cars and other stuff are worth maybe $50,000. Add it up, and John has a net worth of $960,000. He's not quite a millionaire, but he's close. His neighbors think he's doing great. His parents are proud. But here's the reality of John's situation. If John lost his job tomorrow, how much of that $960,000 could he actually access? The home equity is locked unless he sells the house or takes out a loan, which would mean monthly payments he couldn't afford without income. The 401k would cost him a 10% early withdrawal penalty plus income taxes, so that $370,000 would become maybe $240,000 after taxes and penalties. He's got about $100,000 in liquid assets between the savings and the brokerage account. So despite being on paper worth almost $1 million, John's actual accessible wealth in an emergency is about $100,000. He's wealthy on a spreadsheet, but vulnerable in reality. But now you might think, well, that's just how wealth building works. You accumulate assets over time, and eventually you have financial security in retirement. And sure, that's a story we've all been told. But let me show you why that story is incomplete and why it serves a very specific set of interests. Let's go back to Rome for a minute, then I'll connect the dots. Remember how Trajan's loan program created this two-tier system? Here's what happened to the money flow. Wealthy landowners borrowed at 5% interest. They used that money to expand their estates, which increased their productivity and income. They paid back the 5% interest, which funded food for poor kids. The kids grew up and needed jobs. And conveniently, the expanded estates needed laborers. So the workers generated value that went to the estate owners, a portion of which was paid as interest, which funded food for the next generation of workers. It was a closed-loop system that looked generous on the surface, but structurally transferred wealth upward. The landowners got richer from the labor. The government got political stability from the food program. The workers got survival, but not advancement. Now let's talk about the modern version. And this is where people get uncomfortable. Your 401k and your home equity are the modern equivalent of Trajan's program. Not because they're bad or predatory by design, but because of how they function in the larger system. Let's start with the 401k. The program was created in 1978 as a provision in the tax code. It wasn't designed to replace pensions. It was supposed to be a supplement for executives to defer some income. But corporations saw an opportunity. By the early 2000s, traditional pension plans were disappearing, replaced by 401k plans that shifted investment risk from the employer to the employee. Here's how the wealth transfer works. You put money into your 401k, which gives you a tax deduction today. The money grows tax deferred. Your employer might match some of it. Sounds great. But that money is locked up until you're 59 and a half, with very limited exceptions. While it's locked up, it's invested in mutual funds and index funds, which means it's flowing into the stock market. Now, who benefits from a massive, consistent, predictable inflow of money into the stock market? The people who already own significant amounts of stock, large institutional investors, company executives with stock-based compensation, wealthy families with diversified portfolios. Between 2000 and 2023, American workers put approximately $700 billion per year into 401k and similar retirement accounts. That's $700 billion of buying pressure that supports stock prices, regardless of whether those prices are justified by fundamentals. And here's the kicker. When you retire and start withdrawing that money, you pay income tax on it at your marginal rate. The government deferred collecting taxes for decades, during which time inflation reduced the real value of those tax dollars. You took the investment risk. And if the market crashed right before your retirement, like it did for people retiring in 2008 or 2009, you absorbed those losses with very little time to recover. But wait, you're thinking, the stock market has gone up over the long term. People who invested in their 401ks have built wealth. And yes, that's true for people who had consistent employment, who could afford to contribute regularly, who didn't have emergencies that forced early withdrawals, and who retired during a market upswing rather than a crash. But even for those people, let's look at what actually happened. From 1990 to 2020, the S&P 500 had an average annual return of about 10.7%. Sounds amazing, but inflation during that period averaged about 2.5%. So your real return was about 8.2%. Now subtract the average mutual fund expense ratio of about 1%. Now you're at 7.2%. If you had any years where you reduced contributions or stopped because of job loss or emergency, your actual personal return was lower than that. Meanwhile, the financial services industry collected that 1% fee every single year on trillions of dollars. Let's do the math. If there's approximately $7 trillion in 401k accounts right now, and the average fee is 1%, that's $70 billion per year going to financial services companies just for managing retirement accounts. Over a 30-year career, if you contributed enough to accumulate $300,000, you probably paid about $90,000 in fees. You took all the risk, you had zero liquidity for 30 years, and you paid $90,000 for the privilege. Now, let's talk about home equity, because this is where the wealth illusion gets even weirder. Let's go back to John, our almost millionaire with $440,000 in home equity. John bought his house in 2008 for $350,000. It's now worth $650,000. That's $300,000 in appreciation. Sounds like a huge win. But let's break down what actually happened. Over 16 years, John paid approximately $280,000 in mortgage payments. Of that, about $140,000 went to the principal, and $140,000 went to interest. He also paid roughly $112,000 in property taxes, and maybe $60,000 in maintenance, insurance, and other costs. So John's total cost of ownership is about $452,000. His house is worth $650,000. If he sold it today, after real estate commissions of about 6%, he'd net about $611,000. Subtract his remaining mortgage of $210,000, and he'd walk away with about $401,000. Subtract his total cost of $452,000, and John actually has a net loss of $51,000. But wait, you say, John had to live somewhere. He would have paid rent otherwise. That's true. Let's say rent for a comparable place would have been about $2,000 per month. Over 16 years, that's $384,000. So compared to renting, John is ahead by about $333,000. But that's not the $440,000 in home equity that shows up in his net worth. That's an accounting number based on market value minus mortgage balance. It doesn't reflect the actual economic gain. Here's the bigger issue. That $300,000 in home appreciation didn't happen because John did anything special. It happened because of monetary policy and supply constraints. The Federal Reserve kept interest rates low for years after the 2008 financial crisis. Low interest rates meant higher home prices because buyers could afford bigger mortgages. At the same time, construction of new homes didn't keep pace with population growth and household formation. Restricted supply plus increased demand equals higher prices. John benefited from being in the market at the right time. But now, here's the trap. That home equity is only valuable if John can access it or if he sells and moves somewhere cheaper. If John takes out a home equity line of credit to access that $440,000, he's borrowing money secured by his house. If he loses his job and can't make the payments, he loses the house. If he sells the house to cash out, he has to move. And unless he's moving to a significantly cheaper area, his new housing will cost roughly the same as what he sold, which means the wealth was always somewhat illusory. It existed on paper, but couldn't improve his lifestyle unless he downgraded his living situation. Now you're asking yourself, so are you saying homeownership and retirement accounts are bad? No. I'm saying they're mechanisms that create the appearance of wealth accumulation for the middle class while structurally transferring economic value to those who already have capital. This is the modern version of Trajan's system. You work for decades, you contribute to your 401k, which supports stock prices that benefit large shareholders. You buy a home, which creates demand that benefits existing homeowners and real estate investors. You pay interest to banks. You pay fees to fund managers. You pay property taxes to local governments. And at the end, if everything goes right, you have a net worth that makes you a technical millionaire. But most of that wealth is locked up, illiquid, or needs to be spent down to maintain your lifestyle. So who are the actual winners in this system? Let's identify the antagonists. First, financial services companies. They collect fees on trillions of dollars of retirement assets, regardless of whether those assets grow or shrink. Your risk, their guaranteed revenue. In 2022, the investment management industry had revenues of approximately $260 billion. These companies have a vested interest in keeping money flowing into managed accounts. They spend billions on marketing to convince you that active management or even passive index funds managed by them are essential. They've successfully lobbied to make the 401k the default retirement system, ensuring a captive market. Second, large institutional investors and corporate executives. When your 401k buys index funds, it buys the largest companies in those indexes. The S&P 500 is weighted by market capitalization, which means the biggest companies get the most investment. As of 2023, the top 10 companies in the S&P 500 made up about 30% of the index. So roughly 30% of every dollar you put into an S&P 500 index fund goes to 10 companies. This concentrated buying pressure supports the stock prices of companies like Apple, Microsoft, and Amazon, which directly benefits their largest shareholders and executives with stock-based compensation. CEOs and executives at these companies often receive the majority of their compensation in stock options and grants. When your 401k dollars push up the stock price, their net worth increases. Let me give you a specific example. In 2021, the CEO of a major tech company received a compensation package with a grant date value of about $231 million, almost entirely in stock. That stock is valuable because there's demand for it. Retirement accounts provide consistent, predictable demand. So your monthly 401k contribution indirectly supports executive compensation packages that are worth more than you'll earn in multiple lifetimes. Third, real estate investors and existing wealthy homeowners. When you buy a home, you're competing with other buyers, which drives up prices. Higher prices benefit people who already own property. especially those who own multiple properties or investment real estate. From 2010 to 2023, investors and institutions increased their share of home purchases significantly. In some markets, investors accounted for more than 25% of purchases. These investors often pay cash, which makes it harder for regular buyers to compete. But those regular buyers are still entering the market, still taking out mortgages, still creating demand. And all that demand supports the valuations of properties owned by investors and wealthy individuals. Why do they do it? Because the system is incredibly profitable with relatively low risk, especially when you can influence the rules. Financial services companies lobby heavily to protect the tax-advantaged status of retirement accounts and to prevent regulations that would lower their fees. Between 2000 and 2022, the securities and investment industry spent approximately $4.3 billion on federal lobbying. That's $4.3 billion to make sure the rules stay favorable to their business model. Real estate interests also lobby extensively. The National Association of Realtors is consistently one of the top lobbying organizations in the country, spending about $80 to $90 million per year to protect things like the mortgage interest deduction and to oppose regulations that might increase housing supply or limit investor purchases. How do they hide it? First, by making the system seem beneficial to you. You get a tax deduction for 401k contributions, you build home equity. These are framed as wins, and in some ways they are, but they distract from the larger wealth transfer. Second, by making the costs invisible or abstract. That 1% management fee doesn't feel like much. $90,000 over 30 years is hard to perceive when it's taken a little bit each year. Third, by creating complexity. The average person doesn't understand expense ratios, market capitalization weighting, or how monetary policy affects asset prices. That complexity creates dependence on experts who have their own incentives. But here's the shift I want you to make. You're not a victim. You're operating in a system with specific rules and incentives. Once you understand those rules, you can make better decisions. The goal isn't to opt out of homeownership or retirement accounts. For most people, those are still useful tools. The goal is to recognize what they actually do and don't do, and to build wealth in ways that give you more control and liquidity. So let's get into the empowerment section. What should you actually do with this information? First, immediate defensive move. Go look at your 401k and find out exactly what you're paying in fees. Not just the expense ratios of the funds you're invested in, but also any administrative fees, record-keeping fees, or advisor fees. Most people have no idea what they're actually paying. If your plan offers low-cost index funds with expense ratios under 0.1%, switch to those. If your plan only offers high-cost actively managed funds with expense ratios over 1%, contribute only enough to get your full employer match, then open an IRA where you have more control over fund selection. Here's the math on why this matters. If you have $100,000 in your 401k and you're paying 1.5% in total fees versus 0.1%, that difference of 1.4% costs you about $118,000 over 30 years, assuming 7% market returns. That's $118,000 of your money that goes to financial services companies instead of your retirement. This is not theoretical. This is real money that you can keep by making one simple change. Second, rethink what wealth actually means to you. If your entire net worth is tied up in home equity and retirement accounts, you're not wealthy in any functional sense until you're close to retirement. You're on a track that might lead to wealth, but you're vulnerable to job loss, health issues, market crashes, or any other disruption. Real wealth is optionality. It's having enough liquid assets that you can make choices. You can take a risk on a career change. You can invest in an opportunity. You can weather an emergency without going into debt. So start building liquid net worth outside of retirement accounts. I know what you're thinking, but David, retirement accounts have tax advantages. I'd be stupid not to maximize them. And yes, the tax deferral is valuable, but it's not as valuable as financial flexibility in your 30s, 40s, and 50s. Here's what I suggest. Contribute enough to your 401k to get your full employer match. That's free money. Take it. But after that, consider putting additional savings into a taxable brokerage account where you can invest in the same low-cost index funds but maintain access to the money. Yes, you'll pay capital gains tax when you sell, but long-term capital gains rates are 15 or 20% for most people, which is likely lower than your income tax rate in retirement anyway, and you can access the money anytime without penalties. Third, if you own a home, recognize that it's primarily a place to live, not an investment. The appreciation is nice if it happens, but it shouldn't be your primary wealth building strategy. If you're in a high-cost area and a significant portion of your income is going to mortgage, property tax, and maintenance, run the numbers on whether you'd be better off renting something smaller and investing the difference. I know homeownership is emotional. I know it feels like the responsible adult thing to do. But being house poor is not building wealth. It's building equity that you can't use while limiting your ability to invest in assets that might have better returns and more liquidity. Fourth, start thinking about wealth concentration and how you can position yourself to benefit from it rather than just contribute to it. Remember, the big returns go to people who own assets before they become widely popular. The S&P 500 index contains yesterday's winners. By the time a company is big enough to be in the index, much of its explosive growth has already happened. If you want to build serious wealth faster than the slow 401k path, you need to take concentrated positions in things you understand before everyone else piles in. Now, I'm not saying to gamble on meme stocks or crypto shitcoins. I'm saying to develop actual expertise in a specific area, whether that's a sector of the stock market, real estate, in a specific emerging neighborhood, a side business, or even collectibles or alternative assets, and make informed bets based on that expertise. Diversification is designed to prevent you from losing everything, but it also prevents you from winning big. Wealth concentration, when done with actual knowledge rather than speculation, is how people move from comfortable to actually wealthy. Let me give you an example. Back in 2011, a reasonable person could have looked at Amazon and recognized that e-commerce was going to grow and that Amazon was positioned to dominate. The stock was trading at around $10 per share, split adjusted. If you had put $10,000 into Amazon instead of a diversified index fund, that investment would be worth approximately $170,000 today. The S&P 500 over the same period would have turned that $10,000 into about $43,000. That's a difference of $127,000 from one informed decision. But here's the thing. Making that decision required research, conviction, and risk tolerance. It also required having $10,000 that wasn't locked in a retirement account, because you might have needed to sell at some point for life reasons, and you can't predict that in advance. This is why liquidity matters. This is why having money outside of tax-advantaged accounts gives you options. Fifth, understand the difference between median and mean when it comes to wealth statistics, because this reveals the concentration issue. When you hear that the median net worth of American households is $192,000, that's the midpoint. Half of households have more, half have less. But the mean, the average, is much higher, around $1,100,000. Why the huge difference? Because wealth is extremely concentrated at the top. A small number of households with tens or hundreds of millions of dollars pull the average way up. This tells you that the typical experience is very different from the average calculation. In fact, if you look at wealth distribution, the top 10% of households by net worth control about 67% of all household wealth in the United States. The top 1% control about 32%. So when we talk about 24.5 million millionaire households, we need to recognize that many of those are clustered in the 1 to 2.5 million range, which, as we discussed, is largely home equity and retirement accounts. And then there's a much smaller group with tens or hundreds of millions who are operating in a completely different financial reality. Here's why this matters to you. The system is designed to move you into that $1 to $2 million category through homeownership and retirement savings which keeps you economically stable enough not to revolt, but not wealthy enough to stop working or to challenge the structure. You're a successful participant, but you're still a participant, not an owner of the game. The people with tens or hundreds of millions didn't get there by maxing out their 401k and paying off their mortgage. They got there by owning businesses, holding concentrated positions in assets that exploded in value, or being in the right place in a growing industry with equity compensation. So if your goal is to actually build substantial, life-changing wealth, not just comfortable retirement, you need to think like an owner, not like a saver. That means developing skills that are valuable enough that you can demand equity, not just salary. It means starting or buying into businesses. It means taking calculated risks with money you can afford to lose. And it means recognizing that the slow and steady path, while safer, is also capped. You'll probably be fine. You probably won't be wealthy. Sixth, let's talk about the $1 million milestone specifically and why it's a psychological trap. $1 million is a nice round number. It feels significant, but it's arbitrary. In high cost of living areas like San Francisco or New York, $1 million net worth barely qualifies as comfortable. In lower cost areas, it might be genuinely substantial. The point is, focusing on a specific number without context is meaningless. What matters is, can your assets generate enough passive income to cover your lifestyle? That's the actual measure of financial independence. If you have $1 million invested at a 4% safe withdrawal rate, that's $40,000 per year. If your lifestyle costs $80,000 per year, you're not financially independent. You still need to work. If your lifestyle costs $30,000 per year, you're past the threshold. So the question isn't, am I a millionaire? The question is, what's my FI number based on my actual life? And how do I get there in a way that doesn't require locking up all my money until I'm 60? Seventh, stop listening to financial advice designed for the masses. Most mainstream financial advice is built around keeping you as a consistent participant in the system. Save 10 to 15% of your income. Invest in diversified index funds. Pay off your mortgage. Max out your 401k. This advice isn't wrong. It's just designed to produce a very specific, mediocre outcome. It's designed to get you to retirement with enough money not to be a burden on social programs, while ensuring that your money flows through institutions that profit from managing it. If you want a different outcome, you need different inputs. That might mean saving 40 or 50% of your income, which requires lifestyle decisions that most people aren't willing to make. It might mean concentrating your investments in areas where you have an edge, which requires education and risk tolerance. It might mean starting a business, which requires time and effort beyond your day job. None of this is easy. But easy and common produce common results. Eighth, recognize that inflation is a hidden tax that disproportionately affects people who are trying to save their way to wealth. If your money is sitting in savings accounts earning 1% interest while inflation is running at 3 to 4%, you're losing purchasing power every year. Over a decade, money that just sits loses about 30% of its value at 3% inflation. This is why the $1 million milestone keeps moving. It's why your parents could buy a house for $80,000 and you're looking at $400,000 for something comparable. The only way to beat inflation is to own assets that appreciate faster than inflation. Historically, that's been stocks, real estate, and businesses. Notice what's not on that list: savings accounts, bonds in low-interest environments, and cash. So, if a significant portion of your net worth is in low-yielding, safe assets, you're guaranteeing that you lose ground in real terms. Safety has a cost, and that cost is paid through inflation. Let me bring this all together. The number of millionaires in America has increased dramatically, but that increase is mostly a function of asset price inflation and the structural features of 401k plans and homeownership. Most of these millionaires are not wealthy in the traditional sense. They're people who've participated in the system for decades and accumulated paper net worth that's largely illiquid and partially illusory. The real wealth concentration is happening at much higher levels among people who own businesses and hold concentrated positions in appreciating assets. The system isn't broken. It's working exactly as designed. It funnels consistent investment flows into markets, which supports asset prices for those who already own assets. It creates a stable middle class that's financially comfortable enough not to cause problems, but dependent enough to keep working. And it generates enormous fee revenue for financial services companies. You can be angry about this, or you can understand it and use that understanding to make better decisions. Here's what I want you to take away. First, becoming a technical millionaire is easier now than ever, but it means less than ever. Don't confuse a net worth number with actual financial freedom. Second, the traditional path of maxing out retirement accounts and paying off your house will likely get you to a comfortable retirement, but it won't make you wealthy and it won't give you options in your prime working years. Third, real wealth comes from owning assets that appreciate significantly and that you can access and use to create more opportunities. Fourth, the financial services industry and large asset owners benefit enormously from your participation in retirement accounts and real estate markets. That doesn't mean you shouldn't participate, but it means you should do so with eyes open and with a plan to also build wealth outside those structures. Fifth, liquidity and optionality are more valuable than most people realize. Having access to capital when opportunities arise is how you make significant jumps in wealth. And finally, if you want outcomes that are different from the median, you have to make decisions that are different from the median. That's uncomfortable. It means going against conventional wisdom. It means potentially being wrong and looking foolish. But it also means having a chance at actually building substantial wealth, rather than just comfortable stability. The choice is yours, but at least now you understand what the choice actually is and what the